How's it going, guys? My name is Eish, and welcome back to MoneyMetEish. March is the start of the new tax year, and that means that our annual tax-free savings account limit gets reset and that we can once again work towards maxing out that annual 36,000 Rand limit. Last week, I got a request to do a deep dive into my tax-free savings account, and since fellow South African YouTuber Peter at MoneyMarks, check out his channel down below, had a look at the most tax-efficient ways of using the tax-free savings account, since, you know, saving tax is kind of the point of a tax-free account, I thought I would go through our account and have a look at each of the holdings, see how much money we have in each one, and why we own them. At the end, I'll share a tactic that I use to get the most out of our tax-free savings account, even when the annual limit has been reached every year. But before we get started, please remember to hit the like button to help the channel grow, and consider subscribing down below to see more content like this. Please also remember that my videos are meant for edutainment purposes only, as I'm not a financial advisor, this is not financial advice, and this is a blank cup. For more information about blank cups and how to work with MoneyMetEish, contact us via email at moneymeteish@gmail.com. Keeping in mind that this is just what we do with our money, and without any further ado, let's get into the video. Before I have a look at the holdings in our tax-free savings account, let's do a quick recap of what a tax-free savings account, or TFSA, is. I have made a video about this before, but here's a quick recap. A tax-free savings account is an investment vehicle which is rather poorly named, since it's neither a savings account nor truly tax-free. This is because although you can withdraw your funds at any time, you do have a lifetime limit of 500,000 Rand as of the date of recording this video, and this means that any funds that you withdraw can never, ever be replaced, meaning that this account is better used and thought of as a retirement account than as a savings account which you can use for your next holiday or for your school fees. As for being tax-free, well, you are still subject to a few taxes, as the funds you would be investing would already have been taxed at your personal income tax rate. The account would still be subject to estate tax upon your death, and you still have to pay dividend withholding tax on dividends paid by foreign companies. Again, MoneyMarks does a really good job of going into the tax details in his video, so check it out. A tax-free savings account therefore offers you the benefit of not having to pay capital gains tax, or CGT, or dividend withholding tax from companies that are domiciled within South Africa. Now that we're all caught up on what a TFSA is, let's look at what we hold in the MoneyMetEish tax-free savings account on EasyEquities. If we look at our tax-free savings account in total, it counts for 67%, or 2/3 of the total MoneyMetEish portfolio's value, and this year hasn't been kind so far. But since this account has such a long-term focus, and the fact that we generally make monthly contributions, I'm really not that bothered. We're always saying that time in the market is better than timing the market, and so this current downturn and move into bear market territory is A, part of market cycles, and B, it allows us an opportunity to buy what we were already going to buy anyway at a much lower price. We've contributed a total of 58,220 Rand over the last 15 months that we've had the account active. This is split over 3 different tax years, including this one. Our current value is 56,404 Rand and 3 cents, which is an unrealized loss of 3.1%. This is due to our massive exposure to the USA. Of the roughly 58,000 Rand invested in the account, 44,500 of that is invested in the US markets through the various ETFs we hold in the portfolio. Even the Core Shares Global ETF is a feeder fund which is 100% invested in the Vanguard Total World Stock ETF, which has almost 60% of its holdings listed in the USA. With that in mind, let's have a closer look at each holding, going from our largest holding to our smallest holding. The Signia S&P 500 is our single biggest holding, both in this account and in the portfolio as a whole. It accounts for just under 30% of our tax-free savings account and a fifth of our total portfolio. We currently have 16,800 Rand invested in this ETF. We're currently up 2% on this holding overall, which means that if we were buying in now, we're buying in pretty close to where we would have in 2020. The S&P 500 represents roughly 83% of the domestic equity market cap of the largest economy on earth. But beyond being the 500 largest companies listed in the US, there are other factors which go into whether a company is eligible to be included or not. According to Standard & Poor's, aka S&P, to be eligible for inclusion in the S&P 500 index, a company should be a US company, have a market cap of at least 11.8 billion US dollars, be highly liquid, have at least 10% of the company's outstanding shares held by the general public, and it needs to have a positive earnings for its most recent quarter as well as the 4 previous quarters. These strict barriers to entry mean that a lot of the work of having to screen for great companies has already been done for us. Now, a lot of people might think that investing just in the S&P 500 means that you are just investing in the United States, and although these are all US companies, it doesn't mean that they are solely operational in nor reliant on the US for their income. The constituents of this index are global companies with a global reach, and companies like Coca-Cola and Mondelez have their products manufactured and sold all over the world. Even the smallest companies in the index, being Under Armour and Ralph Lauren, have global supply chains and sales networks. So investing in the S&P 500 isn't just investing in the United States, as it might appear from a broader view. We could go much deeper into far more detail about the S&P 500, but we still have 5 other holdings to look at. I own the Signia S&P 500 because it is the cheapest S&P 500 ETF available in the tax-free savings account on EasyEquities with a total expense ratio of only 0.19%. Now let's look at our second holding. The CoreShares Total World Feeder ETF is our second largest holding, making up a quarter of our tax-free savings account and 17% of the total MoneyMetEish EasyEquities portfolio. It has a value of just under 14,400 Rand, and we are currently down 4.8% on this holding. I will be adding more in bucket loads if it stays around this level or drops even further. As I stated earlier, this feeder ETF has one holding, which is the Vanguard Total World Stock ETF. The Vanguard ETF is made up of 9,350 companies from over 40 countries, and unlike the S&P 500, neither the country of registration nor the market cap matters for this ETF, and its goal is to track the global economy. The ETF holds large, mid, and small cap stocks, but it is still highly concentrated in the US, with 60% of the holdings being USA companies. The 4 countries that make up the remainder of the top 5 are Japan, the United Kingdom, China, and Canada, which honestly makes me a little bit uncomfortable knowing that around 3.5% of the index is held in dodgy VIE structures, but what are you gonna do? Indian companies make up 1.6% of the index, while South African companies make up just 0.4%. The idea behind holding this ETF is that it is more diversified than the S&P 500, both geographically and in terms of its sheer size. Basically, it's just there to catch anything that we miss by investing in the S&P 500. These 2 ETFs make up the spine or the core of our tax-free savings account, and we contribute to them every single month, even when our annual allowance is maxed out. Find out how later. The remaining holdings are more embellishments to the portfolio and are capped at 10,000 Rand investments every year. The first of which is the CITRIX Nasdaq 100. It is our 3rd largest holding at a 5th of our tax-free savings account and 13% of our overall portfolio. It currently has a value just under 11,000 Rand and is 6% higher than where we bought it. This even though the index has actually fallen 20% year to date. The Nasdaq 100 is an index made up of the 100 largest, most actively traded stocks listed on the Nasdaq exchange. Notably, it does not include any financial industry companies, and thus is often referred to as a tech-heavy index. It is far more volatile than the S&P 500 since it has more speculative companies among its constituents, but it has returned higher returns than the S&P 500 over the last 15 years. It also tends to be beaten down far more during bear markets and recessions. We hold this ETF for its higher growth rate than we get from the previous two ETFs. That being said, all three are down at least 15% year to date, with the Nasdaq down 20%. The biggest holdings in the S&P 500, the core shares, Total World, and the Nasdaq 100 are all the same companies, just at different weightings. This does increase our concentration risk both geographically into the United States as well as by sector, since these are mostly mega cap tech companies. I believe, however, that these companies offer a decently wide range of income within themselves, and so I even hold a few of them, like Microsoft, Amazon, and Alphabet, as individual holdings in our portfolio as well. It's hard to find companies that generate nearly as much cash and that are as innovative as the top companies in these indices. Coming in at number 4 at 14% of our tax-free savings account and 9% of our total portfolio is the Signia 4th Industrial Revolution ETF, or as I like to call it, the Poor Man's ARK Innovation Fund. I'm not gonna lie though, this was pure FOMO. It had gone up so much in the year leading up to me buying it, and I got suckered into the hype and the gains, and I bought it at a really high price. The holding has a value of 8,000 Rand, which is a 22% drop from the 10,500 that we've put in. I've committed to keeping it for at least 5 years, and so I'm not gonna sell it, especially not at these really low prices. I'm not sure whether I'll be adding more to the holding. Certainly not right now, but I mean, possibly in the future. I guess it would make sense to add more just to bring our average purchase price down, since I'm going to be holding it anyway. I'm just going to go with Signia's suggestion on this and hold it for that amount of time. Whether I'll add more or not this year is up for debate. It's really more of a chore at the moment than anything else, and is certainly not a major conviction of mine. It was a lot of money to spend on FOMO. And that's all I have to say about the Signia 4th Industrial Revolution. Really, I didn't do the research. I can't even name 3 companies that are in the ETF. It was a poor decision. I FOMO'd up. Our second smallest holding in the portfolio at 10% of the tax-free savings account and 6% overall is the Sentio HIFI Sharia General Equity Unit Trust. It's the only unit trust we own, and it holds 5,200 Rand at a gain of 5% from when we bought it. I was doing some promotional work with Sentio last year, and while I was researching their offerings, I thought that this unit trust would be a great option, and it would give me a greater exposure to South Africa, while also giving me access to a few companies in the Middle East. There was absolutely no requirements for me to buy any of their products as part of us working together, and this holding was added after our work together came to an end. I must admit though that having direct access to the fund manager and having him contact me last year when I landed up in hospital does make this one of the easiest and most comfortable holdings in my portfolio, and I will be looking to add more to it in the course of the year. And finally, our last holding is both the newest and the smallest, and that is the CITRIX India Feeder ETF, which tracks the MSCI India ETF. I did a whole video looking at this specific ETF in greater detail before it IPO'd, as well as a written report on the ETF and the Indian economy as a whole, where I compared the Indian and South African economies to get a greater understanding of what we are investing in. They're all linked down below, and you can watch the video over here. I bought this ETF because I felt like India was underrepresented in the core shares ETF, since it's the world's 6th largest economy, but weighted outside the top 10 in the index. I thought that this would give us greater and direct exposure to the world's second most populous country. The holding is currently 1% of our total portfolio at just under 1,000 Rand, and my goal is to grow that to around 10,000 Rand during the course of the year. So, that is the full breakdown of the MoneyMetEish tax-free savings account. Let me know if you hold any of these ETFs or what ETFs you hold in your tax-free savings account down below. Now, where can people find information about different ETFs? I like to use two places when I look at ETFs. So the first is the EasyETFs website. I did a whole video on EasyETFs and how to use it before, and you can find that video over here. The second is directly from the provider. You can go to the ETF provider's website and download a fact sheet or minimum disclosure document, or MDD, for any of their ETFs or unit trusts. This document has all the information about the ETF or the fund, and if you're going to be trusting anyone to give you the right information, you might as well trust the company that you will be entrusting with your hard-earned money. And finally, what do I do when our allowance for the year is maxed out? Once I've reached our annual 36,000 Rand limit every year, I continue to buy our core Signia S&P 500 and core shares Total World ETFs in my ZAR account every single month. I do this until the start of the new tax year, where I sell out of the ETFs in the ZAR account and transfer that money from the ZAR account to the tax-free savings account and buy the same ETFs in the exact same proportions. I do this for a few reasons. I believe that since this is money that I am using to invest passively, it is better to have the money in the market than sitting on the sidelines. As we always say, time in the market is better than timing the market. And I am going to be buying those ETFs anyway. There is little point in me waiting a year to put the money into the market, so I might as well do it this way. There's also very little spillage other than the fees you pay to buy and sell, which is negligible on EasyEquities, the buy and sell spread, and possible capital gains tax, which is also negligible for us personally since we get 40,000 Rand CGT allowance every year, which I'm nowhere near maxing out. This allows our money to stay invested for longer than it would be if I weren't doing this, and basically gives us extra time for our tax-free savings account. That's what we do anyway. Let me know what tips and tricks you use to maximize your tax-free savings account down below. Thanks for watching, guys. I know this was a really long video, so thank you for staying until the end. If you liked this video, please hit the like and subscribe buttons down below and ring the bell to be notified when we upload new videos. You can also follow MoneyMetEish on Instagram and Twitter and everywhere where MoneyMetEishes are, as well as joining us on Patreon, where we have a budget and portfolio tracker, and we will be posting exclusive content there in the future as well. Thanks again, and good night.